Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
G'day everyone, how you going? Episode 2, Series 3, Investing Insights of the Right Property Group. Phil Tarrant here, one of your co-hosts. I'm joined by Steve and Victor from the Right Property Group. Gentlemen, how you going?
Good, Phil.
Awesome.
Good.
Absolutely awesome.
Yes?
Yeah.
You're winding up yet for Chrissy?
Do you know something I don't? Like he's looking at me. He's got a problem?
I'm always a bit nervous.
We're always nervous.
Always nervous. And that's the mantra of all good property investors, right? You know, always be nervous, always be paranoid.
No, just always be risk aware.
Okay.
And it's risky.
Good answer, Steve.
Mr. Conservative. He's got quick after doing this for 2.5 series now. So what's going on? You're winding down, you're hanging up the negotiation boots and taking it easy, or you're still right there in the trenches hunting out bargains?
Just same thing. Everything goes on as usual. Obviously, there's some closures over the Christmas break, especially with the financiers and the solicitors and what have you. But for us, we always think, and a lot of other advisors always think, this is a pretty good time of the year, especially with the challenges we face around finance now for everybody, including the general public. So it's just a good time of year, and we'll be out there about making offers.
And the phone calls from the agents don't actually stop.
Yeah, they don't
because people
stop.
still need to sell around this time.
Yeah.
So it's always good to have your phones turned on.
Do you sort of sense a bit of desperation in the agents as you get close to Christmas, where people start getting a bit jerky and
they
really
do.
need to do stuff? Yeah.
Because they want to fill their pipeline in terms of their income, so their commissions for that January, February quiet period. So they push as hard as they can now to get what they can now. But on the other side of the coin, the sellers too, the vendors, and I'm just being very general here, coming off the back of Christmas where they've spent, maybe some increased credit card debt, presents, holidays, what have you, sometimes they become a little bit more motivated to sell. But also on the flip side of that, sometimes they have that Christmas time to reflect and take
and
their
the family members in the ear. and all
or
this
take
sort
their
of
property
stuff.
off the market and just say, you know what, it's all too hard. We'll hang on to it. So it can go one way or the other. We like this time of year.
So we got some pretty good feedback from this is the second episode of Series 3, and we've had a bit of reshuffle and a rebirth of our new jingle coming in with a big guitar riff. It seems to have gone down well, and we put it out to you guys whether or not you wanted to keep it, and I think the consensus is keep it, which is good. And the back end of our episode 1 of Series 3, we introduced a new thing, our questions at the end of the podcast. And I've got some questions here, and I've looked through them, and I've decided this week to do one around renovation. So we'll touch that towards the back end of the podcast, if that's all okay. What I want to do today, guys, is we received quite a considerable piece of writing from one of our listeners, and that goes by the name of, I see that on rustling paper here, Phil. I've had to turn it over. That's how long this is. He's put together, he's penned a piece here, which is interesting, and I thought we could use that as a way we can steer our conversation today, because by reading this, it's a little bit emotive, it's positioned in a particular way to try and maybe realise or justify a decision that Phil is making. So what I'm going to do, I'm going to read it out, just so you can get a bit of an idea of what this is. So bear with me. It might take me a couple of minutes, but I'll go through it all, and then we'll look at how we can dissect this and find some themes that we can chat about. Because I think a lot of investors probably thinking a similar way to Phil. So I reckon we can pull out a couple of things out here and unpack them and give some sort of guidance on how you might be able to approach it. So the email, which is how it come in, says, "Hi, Steve and Victor. Firstly, let me apologise for the negative tone of this email. Something just triggered me after listening to the last podcast. I have a topic that I'd love for you to discuss." Phil writes, "Having listened to you and other property podcasts, I get the sense that those involved in property are averse to shares, whereas those in shares are open to property. I've only recently started to tune into share investment podcasts and books and was quite surprised by this finding. I asked myself why. We are all in the investing game for the same reason, to make money, but why is property against shares? I put this down to one main reason. You all have something to gain from promoting property, but nothing to gain from shares, i.e. your businesses benefit from people having property." Phil writes, "I currently own 4 properties in Adelaide, all within 5 kilometres of the CBD, in what would be considered blue chip locations. The longest one I've held has been for 8 years, and the capital has increased by 25% in this time. Others are in a very similar boat. Nowhere near the inverted commas double in 7 to 12 years that's promoted by everyone. Thankfully, we're in a very, very fortunate position to be on a combined income of over $300,000, so holding these properties has not been an issue. but here is my current thinking. Some bullet points here. 1, horrendous yields across most of the blue chip areas in Sydney. Second one, the requirement to negatively gear a property for quite some time is almost unavoidable in today's market. Third point, relying on the market to double in 7 to 12 years. As mentioned above, I don't think this is realistic. Maybe in some parts of Australia, but I don't see how a 600,000 townhouse on the outskirts of Adelaide will be $1.2 million in 10 years. ... I know history has shown this, but as you always say, past performance is not an indication on future performance. And his last point, thanks for this, Phil, is the property investment strategy game relies on capital growth that may not happen. On top of this are the numerous costs and headaches associated with a property portfolio. Given this, why I should hold on to negatively geared property, brackets, maybe I don't completely understand the benefits of negative gearing, but my simple mind says money is better in than money out. Another podcast topics perhaps, end brackets. In the hope that property cycles will outweigh all of my holding costs and give me greater return than compared to the share market. I'm nearly done, so bear with me, please. The shares I'm looking at are ETFs and LICs, LICs. These are a consistent dividend yield of 6 to 8% with growth on top of this, much better than any properties at the moment. They also have a very low holding cost of 0.007% to 0.14% management fees. This to me seems like a no-brainer. With an initial deposit of $300,000 plus 80K yearly, compounding interest, tax-free dividend reinvestment schemes, I find it hard to see why I would continue to invest in property. He concludes, I see myself reaching an unencumbered income of $200,000 a year faster this way, which he's referring to as ETFs and LICs rather than property, and with numerous less headaches and ongoing costs when compared to property. I've been pro-property in the past few years, and I'm struggling to see the benefits when compared to shares. Conclusion, why should I put my money in property over shares? So thanks very much for that, for Phil, reading that out. I know, thanks for bearing with me on that. I've been practicing reading out stuff by reading my children's books. So that's how I find myself, just to digress really quickly, I find myself when I read children's books, I paraphrase because I don't really read. I just look and I just talk. And I
you
think
make it up as you go along?
Yeah. So reading children's books, I deliberately now read all the words. So that's how I work on doing that sort of stuff. But anyway, so I'm always trying to self-improve. So...
With a 4-year-old's book.
With a 4-year-old book, think about it. If you've got young kids, I find myself making up stories. So actually read the words. It's a good habit. Property over shares. So a couple of themes here, Victor, that I pull out of that. Number 1 would be diversification strategies. Number 2 would be a bias, investment bias. And I'll speak to you guys about that. I'd also say I'd like to have a chat about dispelling some property myths. This 7 to 12 years, for example. I think we should have a conversation around that. I'd like to have a chat around strategy, and I'd also like to have a chat around the management of properties. And importantly, I think we should have a good chat around yields versus capital growth. So we've got a lot to chat through.
Oh, it's a great question.
It is absolutely a good question. And the old myth or the old adage of shares versus property has always been around. We've been on record to say that you've got to diversify and certainly use the property as a base. You can leverage into shares based on your property equity. Certainly shares are a lot more liquid than properties. It's easier, faster to sell shares as opposed to properties in terms of time frame wise. Just a few jargons in there. ETFs, they're basically, for those that don't know, ETFs are very similar to managed funds, apart from the fact that managed funds get traded once the trading floor closes, whereas ETFs get traded during the day. Yep, so pretty much they're managed funds that are being traded. And LICs, they are basically companies investing in other companies, so leveraging, so in terms of lifestyle investments. And they have evolved over the last couple of years with change in technology and ASX, which has sort of given it the platform. But certainly the thing that we need to be mindful of there is when you look at it from a property perspective as opposed to a share perspective, there are some leveraged rules that we need to adhere to, where we might not be able to leverage as highly in terms of these ETFs as opposed to property, depending on the cycle where the property market is at. And so we need to keep that in mind when you're looking at this.
Okay. All right. Elephant in the room, Steve. Mm-hmm. You guys promote property because you guys make your money being in the business of property.
Do we? Or
No, this is
Was that a statement?
This is a statement. So Phil's saying you guys promote property because you're in the business of property.
we promote property as an investment vehicle because that's what we understand and that's what we're good at. Furthermore, from what Vic said, in terms of the whole property versus shares and which performs better than the other, like I don't think we'll be drawn into that because, and we never have been, for the simple reason being that, as Vic said, we are fans of diversification. So property should not be your only vehicle, nor should shares. There needs to be a crossover amongst many different platforms, including maybe even businesses, whatever it may be. So I don't think getting into that argument, I don't think one is better than the other. Both appeal to different risk profiles and both have their pros and cons. The whole liquidity issue or mantra around shares is true. You can sell it in 30 seconds and it'll give you an instant result. On the flip side of that, though, for people like myself who can monitor the share's performance with the simple refresh of your computer screen to see if it's going up, down or sideways, that would just wreak havoc with my bandwidth.
Look, when you're talking about liquidity, right, high liquidity also brings in high risk as well because it does fluctuate and hence the liquidity of it as well. And I remember way back when I started investing and I started both in property and shares, we used to get a beeper, right? So when the shares when the shares would hit a particular price, the beeper would go off. And back those days, I was doing sonography, so doing ultrasound. And, the poor patient with a full bladder, I would have to wait while I go in and put a trade in. It was that clunky.
I can picture that.
I could say it
on your belt, little beep,
Yep,
beep, beep.
absolutely.
Oh, I've got a medical emergency. I've got to run away.
Maybe it wasn't the beep and pager. Maybe it was like the heart monitor or something on the poor patient. Yeah.
And before we go any further, just I don't want to get legalese about this. There's a big disclaimer at the end of this podcast, but this is a very general chat. We're not saying go invest in shares or go and invest in properties. We're just going to break this down and look at this shares versus property debate. And I think a good way to do that is let's look at some of the drivers and mechanics of investment and some of the objectives of that, and then look at it property versus shares. So you've spoken about liquidity to start with.
Sorry, I want to go back one step. Maybe I didn't answer the question well enough. Do we promote property because that's how we generate an income, and I did answer that part. But the reason we don't talk about shares is because we don't consider ourselves enough of an expert to give advice on that.
We're not giving advice around shares because
no,
you're not a share advisor.
I'm not a share advisor. I'm a qualified property investment advisor. So that's what I talk about. It doesn't mean that I don't believe in shares. As I said, you need diversification across your wealth vehicles, and shares give a certain degree or a lot of positives in terms of the vehicle that you control that property doesn't, and vice versa. Do I own shares? Yes. I'm a big believer in being not a consumer, but an owner. So I have bank shares. I'm not saying everyone should go out and have bank shares, disclaimer, but I like it. I like the bank shares. They give a good dividend. They give a good yield.
90% of Australians probably own bank shares plus in their super funds, right?
Yeah,
everyone's got some bank exposure.
Well, I balance them against the negatively geared properties, which we'll talk a little bit about. Apple, same thing. I own Apple gear, so I'm an owner.
Did you buy those shares 20 years ago?
No, I wasn't a lot. I'm not that old.
All right. So shares versus property. Let's continue with this. I like it. Okay, Victor, we're talking about liquidity. So liquidity is how easy is your money available to you. There's pros and cons with that. So pros for that in shares is that you can get your cash pretty much straight away.
Okay. And because it is that liquid, and liquidity is how fast we can sell it. If there is, like right now in property, we've got a lot of negative news. Finance is hard, market's going to crash, the election's coming, negative gearing is going to go away, all of these negative news. Now, if we had the same thing in shares, because there's that ability to really sell down the shares rapidly, you do lose value rapidly as well. Whereas in property, it is a lot more stable. Now, if we were able to trade properties just like we did shares, the same thing would happen in property.
Yeah, it would not be as stable. You'd see an absolute crash over the last 6 months because of that.
Well, it's sentiment driven, right? A lot of share trading is sentiment driven. And you look at organisations, something catastrophic would have to happen for 30% in a day to come off the value of the property.
It would happen in property if property was as liquid. If it had the platform to be able to instantly sell a property and have it settle within hours, then
you'd have the same issues.
I have no doubt that over the last 12 months, we probably would have seen 30 to 40% just because it's consumer driven and the ability to be able to get out of that vehicle so quickly. The very reason that you can't get out of it that quickly is probably why it's given a little bit more stability over the last 12 months, with the amount of negative media and consumer sentiment around it.
And to be fair, also for a pro on the liquidity side, the reason why one of the benefits of investing in property is leverage, and we'll get to that. Leverage being that the bank is willing to partner you on the investment in property. If it was that volatile property, when you look at margin lending within shares, you can get a tap on the shoulder any day saying, "Oh, Mr. Tarrant, you need to top your account up, otherwise we're going to come after all of your stuff." So it gives the lenders greater confidence to invest in property in partnership with Australian investors and homeowners. So for liquidity, there's pros and cons for both. Mm-hmm. Pros and cons for property. It means that if you want to capitalise an opportunity really quickly, or you need money for something else, it's hard to extract that value out of your property quickly.
Absolutely.
Unless you've been prepared beforehand via redraws, line of credits, or offsets, or whatever it may be.
Which we always say. Which we always say,
be liquid. Yep.
Yeah. Okay. All right. And what we'll do, I think we'll summarise this in a bit of an article on smart property investment as well. I think a lot of people ask this question all the time. Victor, I'm going to give you responsibility to coordinate that and make sure it's brilliant as it always
usual.
is. That's good. All right. So that's liquidity. Go and check it out when we put it up online. Capital growth. So Phil has drawn his own conclusions that he gets greater capital growth out of LICs and ETFs versus his experience, and I'll reinforce his experience investing in property in Adelaide. And there again, we'll have a chat about that as well, clustering all these investments in one place, diversification. So do you, Victor, get greater capital growth in property, or do you get greater capital growth investing in shares or vehicles that allow you to invest in shares like ETFs and LICs?
Look, over a longer period of time, because of the stability and because of the fact that you're not, in terms of property, you're not dependent on how a company or how management behaves and therefore affects the share pricing, you're likely to get more growth in properties, with a caveat. There are shares there that have far exceeded property growth. The reason why I'm more pro-property, and I do both shares and property, the reason why I'm more into property is because of the stability and the predictability of growth based on infrastructure, based on simple fundamentals, which I do not have such a direct ability to compare or to research when it is a share price.
So furthermore, and this is not me or yourself, Vic, giving an opinion, but some would say that the basic necessity being accommodation is also a driver in terms of growth.
Yes.
Not everybody needs a BHP share to live, but everybody needs a roof over their head. Right. Now, that's not me trying to put a tick in the pro column. However...
Shelter. Everyone needs
shelter.
It.
Mm-hmm. Yeah,
not everyone needs a BHP share or a CBA share.
No. I mean, the company needs to exist, though, however, because we want the money. But
So you're talking about the things that underpin the value of the asset. So
yeah, but depending on how far you dive into this, the property perhaps wouldn't exist to the degree it does if the businesses such as the banks, which have the shares, didn't exist either. So you can go
because
way
hand in hand.
You can, it is a hand, and that's the point. It is a hand in hand approach, I believe. And once again, not favouring one over the other. We just happen to be the property guys.
Yeah. So if you look at any downturn, any recession as such, traditional investors will abandon the share market and jump into property as being into your safer options, right? So if you look at all the articles during the GFC, there were articles there that saying that people are abandoning the share market and getting into the safe haven of investment properties. Which is the reason behind that. There's a couple of reasons behind that in terms of it's tangible, in the sense that property is tangible, whereas you're looking at share trading as such or share ownership, it is not as tangible. And again, it is more susceptible to your market movement or market sentiment movement. Overlay that with the fact that in a property as an asset, generally you're able to leverage a lot higher compared to a share portfolio. In most cases, you are able to only leverage between 60 to 80% in a share portfolio, whereas in a property, in a good market, you're even able to go up to 95%. And right now, we are starting to see off the back of easing finance, a lot of lenders are coming back in with 90% lending on properties. So you're able to leverage your capital. So in our case, where Phil says he's got 300K, he's able to leverage that capital a lot harder in a property asset type. However, it comes back to the asset selection itself, the diversification, not having all of your eggs in one basket, just like you would in shares.
In one basket,
Yeah.
in one price bracket
Correct.
profile as well. And I think that once again, and this is probably the fifth time I've said it, having them hand in hand or complementing each other actually will pay dividends as well. Because I think Phil mentioned that he's getting 6 to 7% franked dividends or something, didn't he?
Yeah, interest free, I think, as well.
Tax free, you mean?
6 to 8%. Yeah, so sorry, tax free.
Yeah. Depending on how you positioned it and not played with the numbers, but the way that you looked at the numbers, one could be potentially supporting the other,
yeah.
so that the bottom line across your business, and that means multiple investment vehicles, is going a long way towards balancing it. And the other thing too is everything is cyclical. So whilst at the moment property's copping a caning, more so in Melbourne and Sydney in terms of the press, consumer confidence and what have you, shares aren't getting that same spotlight or that moment in the sun.
They
so
do.
to speak.
You pick up the fin most days and it's just blood on the streets, you see.
But that's one day. And then the next day it's different. And this is the measurement of the stock market. At the moment, I think the stock market in America just fell again because of Trump's commentary, which is how easy the market can be manipulated or governed, so to speak, is just by commentary around whatever it may be.
And it's also how, and we've spoken about this before on Investing Insights or the Right Property Group, how you choose to measure numbers. Like they'll go,
This is the key.
The all ordinaries are as low as what they were in August after a spike of whatever. But if you go back 20 years, you go, well, they're 100 points higher, whatever the number is.
Well,
so
you mentioned 20
benchmark.
years. So here's some interesting numbers on the S&P 500. So they measured it. I think it was one of the big accountancy companies did a measurement over the last 20 years of the S&P 500, I believe it was. And over that 20 years, if you had been in the market every single day, so you never took a cent out of it, I think the return was 7 or 8%. Yep.
Annual.
Over the 20 years. If, however, you missed or you were out of the market for 20 of those days over 20 years, so the 20 of the best trading days over the last 20 years, your return went from 7 or 8%, whatever it was, down to 2%. If you were out of the market for the 30 best trading days over the last 20 years, you actually lost money. My point is the time in the market, by not getting in and getting out, which is what shares allow you to do, can be equally as rewarding or equally as dangerous. It just might be a whole futile attempt,
and it's
because there's a correction
growth.
every year. Once a year, there's a correction in the stock market, and I can't remember what the figures are. The government correction, if it falls by 10%, it's a correction. If it's 20%, it's a bear market or whatever it may be. Property doesn't get measured like that because it's not physically possible to measure it on a daily or a per hour basis.
People are trying to do that.
But we do have corrections.
Yeah,
we're in one now.
Corrections. Yeah.
So if you look at this particular scenario, right? So we've got 4 blue chip properties within the Adelaide CBD ring. Yeah. So there's several things, and not knowing Phil's full financial circumstances, I'm just talking very generally over here. Yeah. So there's several things that could have been done better over here, in the sense that we could have diversified it over multiple states. So rather than having everything in the Adelaide market and being totally dependent on how Adelaide market does in relation to the rest of Australia, we could have had it spread over, say, Adelaide, Sydney, Melbourne, as an example. And I bet that if we had held those properties with those numbers in the Sydney market and Melbourne market, we probably would be singing a different tune altogether. And therefore, it is important that you look at it from a diversification point of view and make sure that we are across multiple states, we are across multiple asset types in terms of distance from CBD, and making sure that we are buying in the affordable corridors, as opposed to just only having blue chip where there is a lot more of holding cost in terms of negative cash flow. And because we're in different states, each state moves in a different phase, different cycle. So as an example, Sydney went to a peak earlier than Melbourne, 6 months earlier, and then started in a decline. So if we had property in Sydney and Melbourne, we're 6 months out of step, and therefore we can plan and adjust. And coming back to the whole affordable scenario, if we had the affordable properties, in other words, supporting each other, so we might have a negative cash flow property, and let's try and pigeon pair it with a high yielding property, not in a regional area, still metropolitan. So it could be a house with a granny flat, as an example. We can self-support, and it doesn't impact lifestyle, it doesn't impact cash flow that heavily, and therefore, over a set period of time, we are just sitting back and waiting for that growth to happen. and waiting for that inflection point to happen as well, whether we force that inflection point or whether it comes naturally.
And if we explore that a little bit further back into Adelaide, and we think Adelaide is
It is a good market.
It's a good market. It's going ahead. Perhaps the price bracket was the challenge there.
Yes.
When you look at the yield and the holding costs, all the expenses that go along with owning property. But if we come back, and I'm going to also now bring in the whole double 7 to 12 years.
I was going to say, who's responsible for that mantra? Who made it up?
I just think someone who was actually pushing property many years ago, because it's never been something that we've talked about.
It's one of the sort of biggest sort of myths. Is it a myth? I'm not too sure, but it's maybe a misconception.
I think with the advent of technology, and that was probably based around the last Sydney cycle, so early 2000s or thereabouts, and where there was such a huge market swing upwards where properties did double very, very quickly. In fact, I remember one of mine doubled in 12 months, and not because of...
Geez, that broke the 7-year rule.
Well, it did. See? Myth. Busted. It's... and that was
lucky, yes.
I know, right?
And it was more luck than good management.
Luck comes your way, take it, you know.
If you go back to that particular property, then for 12 years it didn't do much. Yeah, it went through its cycle.
It went through its natural cycle because it had to get back to its averages. And I did those numbers just the other day on that very same property, and it averaged out at, I don't know, 7 or 8%, whatever it was, compound. But that's a Sydney market, and not every market will do that.
Yeah.
Now, to get back to the doubles in every 7 to 12 years, there'll be some suburbs, there'll be some properties, there'll be some property types within a street that could do that. And inverted commas could. But all the moons need to align.
Yeah, and it's reliant on consistent growth.
Or it could be growth that is not genetic. We'll call it genetically modified growth, being that if you take a look at the Geelong market now, I'm not saying that it's doubled, but there were some factors in there that made that market go, and we were in that market too, just saying, but there were some factors within that market which made it go quicker, and a few markets around it.
It outperformed.
And we talked the government grant.
Yes.
Right, so that was a genetically modified driver, if you will, that made that market. And then, of course, you overlay that with affordability. So the myth that properties double every 7 to 12 years is just that. It's a myth. We do not forecast on 7 to 12 years because we know that there will be inconsistencies within the market. Look at Sydney. We just doubled in 5 to 7 years now, but it'll do nothing. And so it's contracted, and then it'll do nothing for a period of time, because that's how we get back to the averages. So if you measure it over the next 7-year block, it probably won't.
Yeah.
So if you look at the last couple of cycles in Sydney as an example, right? So we've gone traditionally in the metropolitan areas, we've gone 4 years of downturn or flat market, and then we've had 5 to 7 years of rapid growth. Yep. The definition of rapid growth is a direct comparison of how slow the market was in the previous 4 years. So we are entering into, if history was to be taken, we're entering into, say, between 2 to 4 years of slow growth in the Sydney market.
Or sideways.
Yeah, or sideways, yeah. So if someone's buying a property right now and they're not manufacturing that growth, coming back to the renovation side of things, manufacturing that growth, what they will find is that they haven't had any growth in the 4 years, and then as growth starts to happen, the general human tendency is it hasn't worked out, let's offload it and let's take our money elsewhere.
And this is when opportunistic property investors
Correct.
get good bargains, and you guys don't. But I think we should park some of these ideas, because I think they might make a really good future podcast around projection and forecasting, how to actually work out what something's going to go up in value. I think it's a bit too much to tackle in this particular discussion, but I would say Phil says within his email here, he just doesn't believe that a property worth $600,000 today is going to be worth $1.2 million in
that's a fair
7 or
statement.
10. But when you go back through history, and he's going, I know history tells us that's what it will do, but I sit there thinking, going, how can a property I bought 5 years ago in Mount Druitt for $300,000 be worth $1 million in 5 years' time?
I did that. That very property that doubled, I remember thinking to myself, how $105,000, that's how much it was when I purchased that property. How can that be worth $210,000? Well, 12 months later it happened, but then how can it be worth $400,000? Well, it happened, and today it's probably worth $550,000, $600,000 or something like that. It does happen, as long as they're in well-located areas. Will it happen?
Well, this comes back to buying well, and which is, again, another completely different
it's a different
scenario.
So it might take 20 years.
Yeah, we'll do. Okay, property versus shares, I think we're doing as well. So how liquidity fits within it, property versus shares. We've just spoken about capital growth. So essentially, that's the good bit. You want your thing to go up in value, property versus shares. Let's have a chat around yields. So it's sort of connected. I was going to chat about cash flow as well. I'm going to separate them because I think they're different things. Yield. So the yield is that what your return on investment is. Steve, property versus shares.
Look, I think horses for courses, and this is where I think the mixture of the two is a really potentially awesome strategy, depending on the type of shares or EFTs you go for and the dividends that it gives you. If we break that down back to the property, if we do go the blue chip area as an example, it's just traditionally we're going to get a lower yield unless you get funky with it and
Why
room
does that
rent or
happen?
whatever.
What's the mechanics behind getting lower?
Entry
price.
price is too high.
Yeah.
Okay.
Yep.
There's only so much rent that you can charge.
So there's less disparity between rents per week versus disparity in the top and bottom of I guess, property values, right? That's the mechanics, isn't it? You can only charge so much.
You can only-
essentially
it's
for,
supply and
for a
demand.
2-bedroom property, irrespective of where it is.
It's supply and demand.
It's supply and demand.
Yeah, and whilst that might say, well, then surely on the inner city or in a blue chip area, you should be able to charge more. Well, there's only so many people that can afford that. I think you're not dealing to the masses, so to speak. But his yields are low. I mean, at 3%, which is typical for a blue chip.
What's a blue chip
Well,
place
that was my
in
next
Adelaide
commentary.
worth, you reckon? Like, it's got to be
could be
600-700 buy-in?
Could be up to 1.5.
Yeah.
It could be 2. In fact, I was down there last week. I'll let you know. I think an Adelaide is a different. It's a different ball game than Sydney or Melbourne.
It's a lower population base as well.
You need
You've
to
got
treat it
keep
differently.
that in mind as well.
Yeah. And there's some good things happening down there, but just back to the yield. And this is where the approach to it in a business-like manner pays dividends, so to speak, because you're looking to balance the numbers with different asset types. And asset types don't necessarily mean houses or shares or businesses. It might be different types of properties so that you can add value, you can add potential cash flow to it via small developments or room rentals or secondary accommodations, whatever it may be, so that you're continually balancing the number, because at the end of the day, cash flow is king, and so is cash flow management. Or if you actually overlay that with some high-yielding shares or FTs and LICs, then once again, you're balancing the numbers, but you just can't leverage as far with those as you can with property.
Okay, so another point I think worth discussing as one of the mechanics of investments, so liquidity, capital growth, yield, is cost to hold. And again, that's different to cash flow.
Well, it erodes cash flow.
Yeah, the cost to hold property, by and large, is more expensive than holding shares.
It is. There's no argument.
Yep.
It just is. You've got management rates, you've got repairs and maintenance, you've got taxes. There is just no way that you could argue away from that. Property costs more, but if you were funky with your numbers and you decided to reverse leverage that back into your initial deposits, and then break that down as a percentage of the holding costs, then it might be different. Well, he's blinking his eyes. Like, what the hell was that about?
Actuarial over here. You
Yeah,
know?
I know,
I thought
right?
you were from the country.
Anything west of Kirribilli is the country, according to
I'm
you.
going to get picked on for that call. I love the country. Yeah. Great people.
Yeah, so just truly reverse engineer it. So if it's 12% of if the management costs are 12%, or the cost to operate that particular asset is 12%, reverse engineer it back into the actual dollar amount that you physically invested, not so much the leverage component.
Which is your return in investment. So if you're investing, say, 100,000 into one property as your deposits and closing costs, what's your return in terms of the end value?
Well, it could be infinite.
Yeah, that's right.
And whilst it sounds really cool, I think you're going to take that so far before you start to play with your own head.
Absolutely. Yeah. At the end of the day, what it boils down to is that if you have a balanced portfolio in line with your financial fingerprints and in line with what you're trying to achieve, whether it is massive equity or good cash flow or a balance of both, which is what we advocate, it will determine which way you go. It determines where you buy, what you buy, and how long you hold onto it and what do you do with it. And do you add secondary dwellings to it? Do you leave it well alone? So is it just a set and forget scenario, or are you actively managing it to actually push it along towards your goal?
Backing up his argument or agreeing with it in terms of the small yield or the low yield and getting to that end goal of a couple of $100,000 a year, I think it was, positive cash flow or whatever it was. And he's got, what was it, 3 or 4 in Adelaide?
4 in Adelaide. Yeah.
Well, let's say it was 4 spread across Australia still. Because you're at the higher level, and there's nothing wrong with that, but because the yield is always traditionally and will always be traditionally low, if just one of those properties is not rented for an extended period of time for whatever the reason may be,
Kills your cash flow.
it's a big chunk of your cash flow that's gone. Yes, less hassle with less properties, but I also believe higher risk as well.
So for the sake of speed, I think you guys have just touched on that cash flow thing. As we said, Victor, you'll write a piece around this and dig a lot deeper into all these different components. I want to finish up just this particular bit around property versus share. So liquidity, growth, yields, the cost to hold, the cash flow. I'll finish it with control. Control is an important thing for me when I think of property. When I control property, it means I make my decisions. Whereas if I'm investing in shares, I'm putting my cash in the hands of a CEO and a board to make the right decisions to make sure that company grows, right?
Let's just mention IOOF.
There you go. You know, but you know they've had some challenges, IOOF. But the control on property is something I get a lot of satisfaction out of. I don't like parking. I invest because I like to invest in something I know and understand. Investing in shares, if you're not really absolutely 100% appreciation of what the business does and who's in charge of it, what their goals are, and that leadership team, that's really really challenging.
That's a good way to put it. That leadership team, and look. Also, let's not forget to mention that those that do shares and do them well, they approach it just like we do with property, and they look for the fundamentals as well. They look for the earning capacities of the company, how much debt they have, and so on and so forth. So they do it well. Unfortunately, the majority of people that invest in shares and property are more passive investors, so they sit back and they just let things unfold. They don't have any real understanding of it or education around it, which is, once again, for both properties and shares. But furthermore, from what you're saying, Phil, in terms of control, for me, that is the underlying reason that property's my vehicle predominantly, is because I control it for the most. I can make a difference to the outcome by renovating, bigger cash deposits, doing something to increase its cash flow, its value, whatever it may be. But I have a direct input into how it's going to perform, whereas with shares, I don't. And that's, once again, not a positive or negative. It's just the way I work. And at the end of the day, if you were to ask most property people why property over shares, it'd be because of the leverage.
Yeah, look, and I think the biggest difference that we haven't really spoken about, although we've skirted all around it, is the fact that with a property portfolio, you can enhance its value by doing some direct work on it, as opposed to a share. You're still dependent on how the company floats and how the general trend is in terms of market sentiment. Whereas in a property portfolio, you can force the growth, you can add value to it, you can add a secondary dwelling to it. So you've got a lot more different ways of enhancing the value, getting closer to your goal, whether it is to add value and sell down to unencumber the other properties, or whether it is to add value, hold on, or just do nothing.
And I think that's a pro for the shares, though, because for shares, you're really just along for the ride.
Yep.
There's nothing you can do.
Well, I'm happy you said that, Victor, because you've given me a great segue into our question this week around renovation. So this point around control is that you can actually tangibly, with your own two hands, increase the value of your property through renovation.
Absolutely, you can.
Which you
Most
cannot
of the
do.
time.
Most of the time.
Most of the time.
A lot of people get it wrong, right?
Yeah.
But so let's get into the question for this particular episode. But before I do that, I think we've done that pretty well. Shares versus property.
I think just to close that off, just so that Phil knows exactly where we stand, is we're not all just about property. I think you should have the diversification. The reason we don't speak about shares is because we're not the experts.
Yeah, and to summarise the points we spoke about leverage, we spoke about diversification, we spoke about investment bias, we spoke about clustering all your assets in one area, so that's a bit of a diversification piece. We spoke about strategy, and we spoke about effective property management, and that's all about yields and cost to operate and cash flow and that sort of stuff. So yeah, that was good. I think we've done well. So questions, I'm shuffling through all of my papers here, and I think Steve has it right in front of him, which he's going to send to me over right now. This question is from Gretel. Thanks, Gretel. Appreciate the question. I won't sort of bore you with the sort of preamble because I'm going to crystallise it. I'm really short of time here. It is there any renovation you would never do yourself, e.g. installing a vanity?
I would never.
Can I answer that first?
Victor, go on. Victor, I know the answer to this. Yeah.
For me to do myself, I wouldn't do any renovation myself. However, that expertise can be bought, and I buy the time and the expertise of the tradespeople, and I manage them.
Says anyone who doesn't know a hammer from a front door.
Are you just saying you're useless and not handy?
I'm not handy at all.
But you got to know what your strengths are, right?
Yeah, absolutely.
And outsource your weaknesses.
Yeah. Whereas when I did have time, I'd love it. But the question is, what would you not do yourself? Anything that requires a licensed tradesman, or it's just downright dangerous.
Sparky work.
So electrical, most plumbing.
Yep.
Things like that. The biggest return on your investment, if you are going to get your hands dirty, is just that sweat equity. So do the laborious,
the crap stuff.
Yeah, the stuff that you did on your renovations. You know, like pulling out the kitchens, ripping out the bathroom.
Yeah. Like demo, anyone can do demo.
Correct.
Anyone can sand. Anyone can paint with a little bit of help.
Because it's also the unskilled labour is also on a per hourly basis some of the most expensive parts of a renovation in terms of the labour content.
Correct.
So you are better off doing that if you have the time. But do your numbers, because sometimes it's not worth you doing it because you're taking away time off your day job or it takes too long. It just you need to do the numbers, but never do anything that is required to be done by a licensed person or anything that has to do with power.
Yeah, you don't want to sort of get zapped, right? But I think it's important, though, if you're doing a renovation, to actually give it a go the first time. I think you can only by doing the job, and often as unskilled labour, the crap jobs, can you really understand and appreciate how long things take. So when you get a quote saying to rip out your kitchen and pull your carpets up or to sand and polish your floors is going to cost X, you've got appreciation for it. Otherwise, just a number that which has no merit. So get your hands dirty at some point. I've done it. You've done it. I haven't done a reno for quite some time.
I haven't either. I was just actually, as you were talking, not that I wasn't listening, but I was thinking, when was the last time I actually
sat on a site and got dirty?
Yeah. It's other than at home all the time. But I just had a quote on one of my places up in Brisbane that needs re-stumping. So for those that don't understand what that means, it means the piers have rusted and I need, I don't know, a dozen new ones or something. And the difference in quotes was astounding. A high quote was $23,000. The lowest quote for exactly the same work, just a tad over $3,000.
So you got to know your numbers, got to know what it costs.
Well,
you've got to know, because otherwise you're going to get ripped off.
Oh, you're going to get ripped. Look, and that doesn't mean all tradesmen are going to rip, but they will. They want to earn as much as they can for as least amount of work. That's just human nature, I suppose. But don't do the skilled work yourself. That's not something that job I wouldn't do myself, because it'd take too long and you got to squat under a house, and I don't know, 6 foot, and it's
scared of spiders.
Yeah, I don't mind spiders, but I also think just knowing what the worth is for them. What you said. A lot of our clients that are based where their renovations are, we're massive fans of them getting their hands dirty and understanding the different components of a renovation, because they get to know what the costs are, so that as they develop their portfolio, and they'll need different trades quotes at different times, they'll have an understanding on the timeliness of jobs, but also what they should cost, and that they don't get bamboozled with the tradie language.
Yeah, invest in your education. And I would also say, be a little bit ambitious as well. Like demolition stuff. If you're ripping out a kitchen or taking tiles off bathroom walls, give it a go. Anyone can pretty much do it as long as you've got some physical capabilities. Sanding, painting, give it a go. It's not too hard. And there's plenty of stuff on YouTube of how to do stuff, right? A lot of people, educate themselves just by doing that. You can even go a step further and try tiling by yourself if you prepare correctly. And
I love tiling.
And tiling's cool. It's a great satisfaction, tiling.
It's like Lego when you're a kid.
Great satisfaction tiling. Like, some of it's a bit sophisticated. You're doing cuts and curves and angles and all sorts of stuff. Leave that to the experts. But if it's just straight out tiling, give it a go.
100%. And I think, to close off, because we are running out
of
of time, if anyone is thinking of doing a renovation at all, full stop, my tip for you would never do a renovation, no matter how minor it is, whilst there are tenants in the property. Do not take that risk. Only do it when it is vacant or empty. It's just not worth it. We've seen many instances where investors have chosen to do the renovation and just move the tenants' stuff with their permission aside, and it's just ended up very badly.
Good counsel. I think we've done well there. It was quite a long one, but I think we've extended these out. If you like the longer form podcasts, we're happy to keep them at this sort of time, which is about 45 minutes. If you want us to keep them shorter, let us know. We're happy for your feedback, positive and or negative. Steve, this is the last one for the year. Hope you have a nice summer break and do all that sort of stuff.
A couple of weeks off.
You too, Victor.
Absolutely.
Festive cheers.
Just before we go, one other thing for Phil, the person that wrote the question in. I'd love to hear his feedback on whether we've answered the question for him, or he feels we've just skirted all around it.
Yeah, I don't know. What do you think you've done?
I think we've answered it fairly.
Yeah. Send us an email, Phil.
Send us an email.
Yeah. And thanks for sending the question to begin with.
Yeah, and look, we're very responsive to this. So send your stuff in, and I quite like using this reader feedback as ways for us to shape our conversation. Victor, what do people do if they want to get in touch?
Questions at rightpropertygroup.com.au.
Okay. Have you got any other news for us? Anything else happening that we need to know about within Right Property Group land? Anything going on?
It's
That's
business
it.
as usual.
Business as usual.
Yep, business
Much
as
like
usual.
the property market.
That's right.
Good. Yeah, thanks. I hope everyone had a great 2018. We'll be back in 2019, ready to roll from January. But use this period over the break to just think about your property portfolio, what your aims, your aspirations are in property, and maybe just use it as a way to recheck where you are on your investment journey and whether there's any changes that you want to make. There is plenty of stuff out there to help you steer you through those decisions. But as I always say, make sure you lean on experts to help you go down this path in property investment. We'll be back again in 2019. We'll see you then. Bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.